Hey, what's up, guys? It's Jonathan here. Wow, we just got the December CPI report, and man, let me tell you, that was one heck of a report. I think that this report is going to be extremely important for the Fed to pay attention to. But let's get into the details of the report, and then we'll talk about how this will probably affect how the Fed sees inflation going forward. So let's start with the results. So the headline number for CPI was 6.5% year over year, or negative 0.1% month over month. And we haven't seen a negative month over month report in a very long time. It is extremely exciting for us to see this number. Mostly the month over month decrease was driven by oil and energy deflation, which is why the market was mostly focused on the core numbers going into this report. And for the core CPI numbers, we had a 5.7 year over year number, a 0.3% month over month number, which is a bit more than the November report, which had us at 0.2% month over month. But we did get a lower year over year, which was very good. And that lower year over year is showing that we are still seeing a massive rotation in inflation. And the surprising thing about all of these numbers is that all of these results came in at expectations. So it was really crazy that the economists finally got it right after many missed reports over the past year or so. So some notable increases in the report was first off food. It was up 0.3% month over month. And this is a slowdown from the half a percentage increase that we saw in November. Food overall and food at home have been on gradual decline since the July readings of 1.1% on the month over month, which is really good news for consumers. Food away from home is up 0.4% month over month, but it has been trending down since October, so that is a good sign as well. When it came to food, one of the more shocking numbers we got was that eggs are up 11.1% in November, and they're up almost 60% year over year. And this is mostly being caused by the avian flu outbreak that's going on. It is causing a very tight supply for chicken eggs, and hopefully we will see this reverse very soon. Another noticeable increase that we got was in shelter. It was up 0.8% month over month on the December read, and it was highlighted in the report as a dominant factor in the December core CPI deflation that we saw. And a really crazy thing that came from the report as well is that it accounted for over half of the increase to year over year CPI rate. If you look at pretty much any source that has data on real estate, what you'll see is that we are starting to see a deflection in real estate pricing, not only on the buy side, but also on the rent side as well. And a lot of times with the CPI shelter reports, they're usually lag what's actually going on in the market by anywhere from 6 to 9 months. We should start to see deflation in shelter in the next couple reports. And this will be very important for us to see the inflation numbers start. This will be very important as it'll play a pretty big role in inflation numbers coming down. When we look at lodging away from home, so like think hotels, Airbnbs, etc., that was actually up 1.5% in the month of December, which is a strong reversal from the numbers that we got in November. And this is a worrying sign because it may show us that we are still seeing an increase in travel demand. So some of the noticeable decreases that we saw in the CPI report was that energy was down 4.5% month over month compared to November where it was only down 1.6%. So we are starting to see a rapid speed up in the decline of energy prices. Gas was down 9.4% month over month, and it was down 1.5% year over year. This is compared to the negative 2% decrease that we saw in November. So we are starting to see the trend of gasoline starting to deflate downwards, which is, again, a very good sign not only for consumers, but also for inflation in general. Because think about it like this. Any good that you buy has a cost of gasoline somewhere in between the raw materials, the development of the good, and you buying the good. Seeing gas prices start to deflect to the downside is a really good sign that we may see overall systematic inflation start to deflect to the downside. Another noticeable index in the CPI report was cars. Used cars and trucks were down 2.5% in the month of December. And this is a little bit less of a slowdown than what we saw in November at 2.9%, but it is good to still see that deflating trend continue with used cars. We all have to be real here. The inflation in used cars was absolutely not sustainable, and we're starting to see the collapse of that inflation right now, which again is a really good sign that supply chains are starting to get better and that car manufacturers are able to meet demand and take some of that pressure off of the used car market. Now, when it comes to new cars and trucks, that index was down 0.1% in the month of December. And this is the first negative month-over-month reading that we've seen in new cars. This is no surprise because what happened is that because there was a lack of new cars, people started buying used cars. Now, since the new cars, like I said, are being able to be produced at a normal rate, it's starting to slow down demand for the used cars, and the dealerships selling new cars don't have the kind of pricing power that they had during the beginning of 2022. Another noticeable index that was down was airfare. It was down 3.1% month over month. And we are starting to notice in this index that the deflationary pressure is ramping up from both the October and November reads, as well as the December one as well. And this is a sign that we are seeing travel demand start to soften a bit. It was very confusing because the lodging away from home went up. I'm not really too sure why lodging away from home went up, but then airfare went down. Travel demand may be playing a role in that. Another thing that could be playing a role in it as well is also the lower gas prices, which do help the airliners out a lot when it comes to costs. Another sector that bolsters that argument that we are seeing softer travel demand is car rentals. The car rental index is currently down 4.9% year over year. It has been on a deflationary path for the past 3 months, further proving that may see travel demand actually soften. So all in all, I think that this was overall a really good report. Hearing that shelter made up more than half of the 5.7 year over year headline CPI increase was huge, especially that we already know that shelter costs are starting to go down. And when you think about it, half of 5.7% is 2.9%. And the Fed is currently their goal is to get to 2% PCE inflation over the long term. And when you compare the PCE inflation to CPI inflation, PCE actually has a bigger section for housing than the CPI. So once we start to see shelter deflation start to hit the CPI and PCE numbers, we do have a chance of seeing the Fed reach their goal of 2% PCE inflation. Even with this really great print that we got, the Fed still believes that they still need to reach their goal of getting us to over 5% federal funds rate, which would require at least 75 basis points worth of hiking. But some Fed officials, like Atlanta President Raphael Bostic, has stated that he believes that it would be appropriate to roll out these hikes in 25 basis point increments. Whereas other Fed presidents, like St. Louis Fed President James Bullard, feel that the Fed should still continue front-loading the rates. Now, to be fair, James Bullard is definitely more of a hawk. He definitely believes that we need to be more aggressive, not less aggressive. So he is definitely on the far end of one side. And this belief is at very strong odds with the bond market, because the bond market is pretty much when investors are making bets with money on what the Fed will do with Fed rate hikes. And currently, the bond market believes that there's only a 65% chance that the Fed will even deliver a 25 basis point hike in the February meeting. And there's actually a 35% chance now that the Fed will not hike at all and pause. And even if the Fed goes along with the 25 basis point hike in February, the market is actually pricing in the Fed to pause in the March meeting, which would leave them about 50 basis points short of their goal of getting us over 5%. And this belief is mostly rooted in the fact that there is a common belief that when inflation starts to fall, it falls very quickly. And this makes sense because you got to think about it like this. For inflation to continue keep going up, that means that prices have to continue going up. So let's just say for example, a gallon of gas costs you $100 in 2022. Well, for us to have 8% inflation in 2023, that gas now has to cost you $108. And then the next year in 2024, that gas now has to go up another 8% for us to have 8% inflation. And obviously, from the report that we just saw, we're not really seeing that in a lot of sectors. So this does give a lot of confidence that we aren't going to see inflation go forever. And it makes it very difficult for inflation to continue to keep going up because it has to keep beating higher and higher comps. So I think that the Fed is mostly keeping this aggressive face about trying to bring inflation down because they don't want all of the hard work that they did in 2022 to unravel and cause inflation to spike up again. And I personally believe that if we do get another good CPI report for the month of January, similar to the one that we got in December, I think that the Fed will have no choice but to pause, because if they continue to keep pushing down this agenda of getting us to over 5% federal funds rate, it will not end well. I don't think it would end well for the economy. It may even push us into a recession. And then the Fed will now have to U-turn and start stimulating again, which probably would not be very beneficial, because we'll just end up in this cycle of, oh, too much inflation, oh, too much deflation, and then this back and forth, and won't be good for anyone. But honestly, time will tell on this one. Personally, for me, when it comes to investing, this isn't personal financial advice. This is just what I'm thinking. Is that I'm looking to really just DCA between now and the March FOMC meeting with all of the cash that I have right now into stocks that have pricing power. And for me, when I say pricing power, that pretty much means those companies that can reduce their prices and still be profitable, because those companies will have money to invest during a recession. I don't know what's going to happen, but that's just the plan that I have right now. So thank you guys so much for watching. As always, if you like this video, please like and subscribe to the channel. Also, share this with someone who you think this would help. And I'll see you in the next video. Peace.